Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. Today, we're breaking down AbbVie Inc., a global biopharmaceutical giant. On the surface, it's a fascinating business doing incredibly important work. But the real question for us as long-term investors is this: is its fortress truly enduring, or are there hidden vulnerabilities the market might be missing? That's what we're here to find out.
That's a massive question. And before we get into the nitty-gritty, just a quick note for everyone watching.
Right. For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Pillar number 1, the business model. So, AbbVie, what's the core engine here?
Okay, let's unpack this. Imagine a company selling products that are, absolutely essential to human well-being. Yet, at the same time, they're facing this constant, relentless race against time, against competition. Today, we're taking that deep dive into AbbVie. It's a global biopharmaceutical giant, and they've quietly, but I think brilliantly, executed one of the most remarkable business transitions we've seen in recent memory.
Yeah, what's truly fascinating here, I think, is that we're trying to look beyond just the daily headlines, the quarterly noise. We want to understand the real underlying strengths, but also the profound challenges. This is a business impacting millions of lives globally, and at the same time generating billions and billions in revenue. So our mission for this dip dive really is to explore the depth of its competitive advantages. We need to assess the resilience, the flexibility of its financial structure, and ultimately, distill what this all truly means for its long-term trajectory as a major pharmaceutical innovator.
And to help you, our listeners, get well-informed quickly, comprehensively, we've gathered a pretty extensive set of materials for this. We're talking in-depth financials, detailed competitive landscapes, mapping out exactly who they're up against, and even what we're calling a simulated scuttlebutt. We've basically sifted through countless customer and employee perspectives to give you that qualitative edge, that real-world feel. It's designed to be a full picture, giving you a genuine understanding. So let's jump right in. Let's understand the foundation. What is the core business model? How does AbbVie actually generate those, frankly, incredible revenues?
Okay. At its heart, AbbVie is a global, research-driven biopharmaceutical company. That's the label. Its fundamental business cycle, it really starts with a colossal investment in R&D, research and development. Now, that includes both funding really ambitious internal science programs, but also strategically acquiring promising drug candidates or even entire companies. It's a mix. This relentless investment, it's all geared towards one goal: building a robust, diversified pipeline of potential new medicines. You have to think of it like a multi-stage marathon, right? It starts with basic research, moves through preclinical testing, and then into those 3 critical phases of human clinical trials. Phase I for safety, phase 2 for efficacy and dosing, phase 3 for that large-scale confirmation, and each stage hosts speaker. It's incredibly expensive, incredibly time-consuming, and let's be honest, carries a really high probability of failure.
Oh, absolutely. The journey from discovering something in a lab to actually getting it onto the market, it can easily take a decade, maybe more.
And for every single successful drug you hear about, there are dozens, maybe hundreds, that just never make it out of the lab or fail in trials.
That sounds like an extraordinarily risky and just incredibly capital-intensive way to run the business. So what's the payoff? Where does the reward come from?
Exactly. The ultimate outcome, the reward for that substantial high-risk investment, is discovering, successfully developing, and then eventually commercializing novel medicines. And these are typically for complex, often debilitating health conditions. But here's the critical piece, the absolute cornerstone of the whole pharma business model: patent protection. Once a promising therapy successfully navigates all those rigorous clinical trials, proves its safety, proves its effectiveness, AbbVie moves aggressively, very aggressively, to secure patents globally. And these patents, they aren't just legal niceties. They are government-granted monopolies. For a defined period, AbbVie becomes the exclusive provider of that medicine. No one else can legally sell it. And that exclusivity is precisely what allows them to command premium prices for these often life-saving or life-altering drugs, which in turn generates the substantial profits, the immense cash flows needed to recoup those huge R&D investments, and crucially, to fund the next wave of innovative research. It restarts the whole cycle.
And the scale you mentioned, it's truly immense. We're talking total net revenues exceeding, what was it, $56.3 billion in fiscal 2024?
Yeah, 56.3 billion.
That's just a staggering figure.
It is. And that revenue, it doesn't just appear out of thin air, right? It flows through a highly sophisticated global commercial infrastructure. This isn't like selling, toothpaste off a supermarket shelf. It involves building these deeply entrenched long-term relationships with healthcare providers, with hospitals, with pharmacies all around the world. It requires a specialized sales force, these medical science liaisons who educate doctors on complex drug profiles, and really intricate supply chain logistics to make sure these critical medicines actually reach patients reliably. And it's also worth noting that geographical concentration you mentioned earlier. Roughly 76% of our total revenue in FY 2024 came from the United States. That highlights both, the lucrative nature of the U.S. pharma market with its historically higher drug prices, and perhaps you could argue a long-term opportunity for AbbVie to maybe further expand its revenue streams by increasing its footprint in other global markets.
Right. So when we dissect that huge revenue number, AbbVie organizes itself into several key therapeutic areas.
Yeah.
We're primarily looking at immunology that's targeting autoimmune diseases like Crohn's, rheumatoid arthritis. Then there's oncology, focusing on cancer therapies, neuroscience for neurological and psychiatric conditions, and aesthetics, which includes, globally recognized products like Botox Cosmetic.
Exactly. And if we dive into the numbers, immunology is still the undisputed heavyweight champion of their portfolio. It makes up a staggering 47.4% of total revenue. But what truly stands out within that segment, I think, is this textbook example of a managed, successful product transition that's unfolded over the last few years. Remember Humira. For well over a decade, it was the world's best-selling drug, generated over $20 billion a year at its peak. When its main patent expired, the market widely predicted, basically a catastrophe for AbbVie.
Right, the famous patent cliff narrative.
Exactly. But their next-gen immunology drugs, Skyrizi and Rinvoq, they've shown just explosive growth. Skyrizi, for instance, brought in $11.72 billion in 2024. That's an incredible 50.9% increase year over year. And Rinvoq surged to $5.97 billion, also with over 50% growth. These two products, remarkably, have more than offset the expected decline from Humira. Humira dropped to about $9 billion, a 37.6% decrease from its peak. This wasn't just luck, it wasn't passive, it was a complex, multi-year strategic maneuver. Very few companies could pull that off.
It's really quite something.
Beyond immunology, neuroscience is also a significant and growing contributor. You mentioned Botox therapeutic for things like chronic migraines and Vraylar for psychiatric disorders. Both are big. And oncology also brings in substantial revenue through drugs like Imbruvica and Venclexta, mainly targeting various blood cancers.
So, okay, despite all the mind-boggling scientific complexity here, developing these cutting-edge therapies, the core business model, when you really strip it down, is conceptually pretty simple, isn't it? It's innovation, driven by massive R&D and then rigorous, often aggressive, protection of that intellectual property through patents. You said that simplicity underpins its enduring strength.
Oh, son.
You've nailed the simplicity, yeah. But understanding the mechanisms behind that simplicity is crucial. This model, it's uniquely anchored in these powerful, non-cyclical, and deeply human trends that are set to persist, not just for years, but for decades. First, there's the undeniable demographic wave, an aging global population. As medical science extends lifespans, the incidence of chronic, complex conditions, think rheumatoid arthritis, cancers, Alzheimer's, other neurodegenerative diseases, it will inevitably rise. This creates an inexorable, sustained, and growing demand for the exact types of innovative therapies AbbVie specializes in. This isn't some fad, right? It's a fundamental demographic reality. It provides a multi-decade tailwind for the whole industry.
That's a powerful, almost guaranteed demand driver then.
Absolutely. And second, maybe even more fundamentally, the model is rooted in this unchanging human desire to alleviate suffering, improve quality of life, extend longevity. Healthcare spending, especially on effective treatments for serious debilitating illnesses, is arguably among the least discretionary expenditures for individuals, for governments. Patients with severe pain or life-threatening conditions, they're not comparison shopping for drugs like they might for, brands of coffee. They want relief, fast. So while the specific drugs in AbbVie's portfolio will definitely evolve, patents expire, science progresses, the fundamental need for new, effective medicines won't diminish. Advancements like AI and drug discovery might dramatically change how the business is done, maybe speed things up, identify new targets, but it won't change why the business exists. That deep-seated human need. It reinforces the long-term relevance, the stability, and the inherent profitability of discovering, patenting, and selling effective medicines.
Okay, let's shift gears slightly to what really protects those substantial profits. The economic moat. For AbbVie, that fortress seems incredibly formidable. It's constantly reinforced by their scale, their deep expertise. What constitutes its primary moat?
The primary economic moat, without a shadow of a doubt, it's their vast portfolio of intangible assets, specifically patents. AbbVie holds tens of thousands of global patents. That alone tells you something about their relentless innovation and their formidable legal defense capabilities. These patents, again, they're not just pieces of paper, they are powerful instruments. They provide that legal monopoly on their products, effectively preventing competitors from launching generic or biosimilar versions for a defined period. This government-granted exclusivity, it's the most powerful barrier to entry you can find in the pharmaceutical industry, period. It directly enables AbbVie's exceptional pricing power, which then leads to those exceptionally high gross margins we talked about. Just to put it in perspective again, Q4 2024 adjusted gross margin was a remarkable 83.8%.
83.8%, wow.
Yeah, that's a level of profitability you rarely see outside of maybe high-margin software companies. It far exceeds typical manufacturing or retail. Without that robust patent protection, those high returns would simply evaporate under intense price competition from generics.
And here's where it gets really interesting, right? There's no better real-world example of this moat in action than what AbbVie did with Humira. When the main U.S. patent was set to expire way back in 2016, conventional wisdom, pretty much everyone, expected catastrophic, almost overnight revenue loss. The floor was going to fall out.
Indeed. The consensus was grim, very grim. But AbbVie's management, their legal teams, they had executed this brilliant, multi-pronged strategy. They constructed what's now famously known as a patent thicket, a dense, overlapping, incredibly complex web of more than 250 additional patents surrounding Humira. And these weren't just on the core molecule. They covered practically every conceivable aspect of the drug, manufacturing processes, specific formulations, dosages, how it could be used for different diseases, even the delivery devices, the injection pens, everything. This legal fortress made it almost impossible for any competitor to launch a biosimilar without infringing on dozens, maybe hundreds, of these secondary patents. The strategy basically forced every potential competitor into what the industry calls a patent dance.
A patent dance?
Yeah, it's a high-stakes, multi-year process of litigation, negotiation, cross-licensing, where they'd have to painstakingly negotiate their way through AbbVie's legal maze.
And the outcome? It was nothing short of extraordinary, wasn't it?
It really was.
Every single major biosimilar manufacturer, even powerful, well-capitalized players like Amgen, Boehringer Ingelheim, they all eventually settled with AbbVie. They agreed to a license-controlled entry into the U.S. market, but critically, only starting in 2023.
A full 7 years after Humira's primary patent had originally expired.
7 years. That delay preserved billions, literally tens of billions, in high-margin revenue for AbbVie.
That's the strategic brilliance right there. That's the tangible impact of an institutional moat. This wasn't passive defense. It was active, aggressive, incredibly far-sighted strategy. It preserved immense value. It bought the company critical time, critical resources needed to develop and successfully launch Humira's successors. It demonstrated that AbbVie isn't just reliant on a single patent. It possesses this deeply ingrained institutional capability to not only discover blockbusters, but also to defend its intellectual property with, frankly, unparalleled ferocity, legal acumen, foresight, all while planning a decade ahead for these expirations.
And yet for years, the prevailing market narrative around AbbVie was that its moat was rapidly narrowing, that it was destined to be a one-trick pony, collapsing post-Humira. It was a very pessimistic view dominating the conversation.
But a deeper analysis, I think, reveals a much more nuanced and actually positive reality. The moat isn't narrowing. It's actively transforming and rebuilding itself. The true moat isn't just the patent on any single drug. It's the institutional capability to systematically discover, develop, protect, and commercialize blockbusters over and over. The spectacular success of Skyrizi and Rinvoq, their next-gen immunology drugs, is compelling proof of this. The precipitous decline in Humira's revenue, it's being more than offset dollar for dollar by the explosive growth of these two successors. In fact, management has confidently guided that their combined revenue is expected to exceed $31 billion by 2027.
$31 billion?
Yeah, which would not only replace Humira's peak sales, but substantially surpass it.
And here's the clincher, I think, that really speaks to the repeatability here. AbbVie is already deploying the exact same patent thicket strategy for Rinvoq. They've built this formidable fortress, hundreds of patents around it, protections extending to 2036, maybe beyond, and they've already initiated litigation against generic drug makers trying to challenge these patents. A full decade before the primary ones are even set to expire. What does that tell you?
It tells you that what happened with Humira wasn't some fluke. It wasn't a one-time magic trick. It is a core, repeatable, deeply embedded competency within AbbVie's organizational DNA. This proactive, aggressive legal defense, combined with their R&D engine, confirms that the Moat's trajectory, far from narrowing, is actually stable. It's robust. They're systematically replacing expiring assets with new, arguably even more powerful ones.
Now let's try and connect some of these insights to those powerful mental models that great investors like Charlie Munger use. First, the Red Queen effect. Munger famously quoted Lewis Carroll, "It takes all the running you can do to keep in the same place."
Oh, the pharmaceutical industry, especially the research-based part, is the absolute quintessential Red Queen environment. No question. A company's patent portfolio, it's like this rapidly depreciating asset. It starts losing value the moment a drug is launched. Every year, new competition emerges. Patents inevitably march towards expiration. So to simply maintain its revenue base, let alone grow, a company like AbbVie has to constantly run this incredibly fast, incredibly expensive R&D and M&A treadmill. Their massive R&D spend, what was it, $10.8 billion in 2024?
Yeah, almost $11 billion.
Right. That isn't just for new growth. A substantial chunk of that is necessary expenditure just to replace the revenue that will inevitably be lost as patents expire.
Right.
That decade-long, multi-billion-dollar effort to develop Skyrizi and Rinvoq specifically to fill that roughly $20 billion hole left by Humira, that's a perfect illustration of AbbVie not just running, but winning this Red Queen race. It showcases long-range planning, exceptional scientific execution, operational excellence, all in a fiercely competitive, constantly evolving landscape. If they stopped running, even for a moment, they'd quickly fall behind.
Okay, another one of Munger's models, surfing. Identifying a massive long-term wave and positioning yourself to ride it for as long as possible. Instead of trying to be good at everything, sometimes it's better to focus intensely on one big, powerful, durable trend.
AbbVie has executed this model masterfully, absolutely masterfully, by establishing and then reinforcing its dominance in immunology. They saw the development of biologic therapies for chronic autoimmune diseases as this transformative multi-decade wave in healthcare. A wave driven by increasing understanding of the immune system and just the immense unmet medical need. They rode this wave to incredible success with Humira, building deep scientific expertise, an unparalleled commercial organization, extensive relationships with key opinion leaders, prescribing physicians, all along the way. And instead of abandoning that wave as Humira's patent life waned, what did they do? They doubled down. They leveraged their accumulated knowledge, their established infrastructure, their deep understanding of the patient journey to develop the next generation of superior immunology therapies, Skyrizi and Rinvoq. This focused strategy has allowed them to become the undisputed leader in the space, and this is consistently confirmed by physician surveys. They rank AbbVie as the perception leader in immunology by a wide margin year after year. By surfing this powerful trend, AbbVie has built a level of focus, scale, expertise, and commercial power that more diversified competitors find incredibly difficult, maybe impossible, to challenge effectively.
Okay, beyond the numbers, beyond the strategy, let's turn to that Scuttlebutt simulation. Let's peer into the qualitative insights, the human element. What are the customers, the patients, saying? What about the employees inside the company? When we analyze thousands of patient reviews for core immunology products like Humira, Skyrizi, Rinvoq, we see this powerful, almost bipolar dichotomy.
Yeah, it's striking. For a large group of patients, people suffering from truly debilitating conditions, Crohn's, severe rheumatoid arthritis, chronic psoriasis, these drugs aren't just helpful, they're profoundly life-transforming. The reviews, they're filled with emotional, heartfelt phrases, things like, Humira has been a godsend, it gave me my life back after years of suffering, or this treatment truly is a blessing. You have to imagine a patient who spent years in excruciating pain, maybe unable to perform basic daily tasks, feeling isolated. These drugs allow them to leave their homes again, return to work, play with their kids or grandkids, just reclaim a semblance of normal life. This isn't, the mild preference you might have for a brand of soda or a new phone.
Yeah.
This is a profound level of customer love, and it's born from alleviating intense, life-crippling suffering. This deep, needs-based value creation. It translates directly into extremely low price elasticity of demand. Patients and their doctors, they're making treatment decisions based on efficacy, quality of life, not a 10% price difference. The switching costs are immense, not just financial, navigating insurance and all that, but more importantly, physically and emotionally. Once a patient finds something that works, that gives them relief, the idea of changing to an unknown alternative with potential side effects or maybe reduced efficacy, it's deeply, deeply unappealing.
But this also inherently highlights the high-stakes nature of these therapies, right? These are powerful interventions we're talking about.
Indeed. The Scuttlebutt also clearly reveals that a significant minority of patients report severe, sometimes debilitating side effects. These can range from increased susceptibility to serial infections, which require constant monitoring, to more specific, unpleasant effects like, say, cystic acne or persistent vertigo. And in rare, tragic cases, the side effects can even be life-threatening. This just underscores that AbbVie's products aren't simple consumer goods. They are powerful medical interventions with a complex risk-reward profile, the intensity of both the positive, transformative outcomes and the negative, severe side effects. It reinforces the non-discretionary nature of the product category. When you're dealing with conditions that severely impact quality of life or threaten longevity, patients are often willing to accept significant risks for significant relief. It's a tough calculation.
So what does this all mean for the people actually working at AbbVie?
Yeah.
When we look at employee sentiment from places like, comparably, Reddit, we see a pretty classic picture, don't we? A large, successful corporation with predictable strengths and weaknesses.
Yeah, it's fairly typical. On the positive side, employees consistently praise the company for generous compensation, robust benefits packages, often great health insurance, retirement plans, and the sheer vastness of resources available for R&D, employee development. There's a palpable sense of financial stability, and for many, there's a genuine pride in the company's patient-focused mission, knowing their work contributes to these life-changing therapies. However, on the negative side, the common criticisms are the ones you frequently hear about large, mature organizations. Complaints of huge bureaucracy, leading to slow decision-making, excessive red tape, stifling initiative, rampant politics within departments, and a culture that some describe, maybe unfairly, maybe not, as a boys' club in certain leadership circles, limiting diversity.
I think I saw one comment about weekly, pointless meetings designed to justify management's existence.
Exactly. That's a classic frustration in big companies. Others reported slow career progression, feeling pigeonholed into an extremely specific role, which can limit broader skill development.
So for you, the investor trying to understand this business, the crucial question becomes, are these cultural negatives severe enough to actually impede the innovation engine, the thing that fuels the moat? Does this bureaucracy prevent them from creating the next blockbuster drug?
Well, the evidence suggests that while the culture might not be a primary asset, it's probably not a source of competitive advantage itself. It's certainly not a fatal liability either. Look at the successful multi-year cross-functional effort required to develop and launch Skyrizi and Rinvoq. That involved navigating complex clinical trials, regulatory hurdles. It demonstrates that the organization, despite these bureaucratic tendencies, can still execute effectively on mission-critical long-term objectives. The culture appears functional enough, let's say, to sustain the business and its innovative output. It might be frustrating for some employees, sure, but it hasn't so far crippled their ability to bring groundbreaking drugs to market.
Okay, let's pivot now to the competitive landscape. AbbVie operates in what's effectively an oligopoly, right, dominated by a handful of global pharma giants. Who are their main rivals, particularly in those core areas we've been discussing, immunology and oncology?
Right. While they compete with a range of companies across their whole portfolio, their most relevant direct competitors in those core areas are primarily Johnson & Johnson J&J and Eli Lilly. Now, each of these competitors has a distinct strategy with its own strengths and weaknesses. J&J, for example, is this highly diversified healthcare conglomerate. Major divisions in pharma, med devices used to have consumer health. This broad diversification gives them immense financial stability. deep pockets. But it can also lead to a diffusion of focus compared to a more specialized company like AbbVie. In immunology, J&J's strategy is built around key products like Stelara, Tremfya. Their R&D approach focuses on specific biological pathways. They're powerful, well-capitalized, no doubt. But their attention, their capital, their commercial efforts are naturally divided across a much broader set of end markets.
And what about Eli Lilly? They've certainly been grabbing headlines lately, haven't they? Capturing a lot of market attention.
Oh, absolutely. Eli Lilly is currently experiencing extraordinary, maybe unprecedented success driven by its GLP-1 platform, Mounjaro's Zepbound for diabetes and obesity. This has become the absolute central focus of their strategy, their R&D allocation, their commercial efforts. Everything is geared towards that right now. The potential market for these metabolic drugs is just colossal. It's captivating pretty much all of Lilly's strategic attention. Now, they do have a presence in immunology, drugs like Taltz, Olumiant, and they've been using M&A strategically to build their pipeline there. But their primary strategic thrust, their capital allocation, it's unequivocally directed at that massive metabolic disease market right now. Lilly is a world-class R&D organization, a fierce competitor, but its immunology franchise clearly isn't its top strategic priority at this precise moment.
So, given these formidable rivals, one broadly diversified, the other incredibly focused, but elsewhere, what then is AbbVie's key, durable advantage in this landscape? How do they stand out?
AbbVie's most durable advantage lies precisely in its unmatched focus and the resulting dominance it has built in the immunology market. While J&J is broad and Lilly is laser-focused on metabolic disease, AbbVie is first and foremost an immunology powerhouse. And this isn't just about having the best-selling drugs. It's a deeply embedded organizational advantage built over decades. We mentioned those physician perception surveys. They consistently, overwhelmingly rank AbbVie #1 in immunology, often by a wide margin over all competitors.
Yeah.
And that leadership. It's the direct result of decades building deep, trusted relationships with key opinion leaders, prescribing physicians in rheumatology, gastroenterology. It's reinforced by best-in-class patient support programs, helping patients stay on therapy, and a massive, highly specialized sales force that is entirely dedicated to understanding and serving this specific therapeutic area. This focused expertise creates a powerful competitive advantage in commercial execution and brand loyalty that's very hard for more diversified or differently focused peers to replicate. It really embodies focused dominance.
Okay, transitioning from the business itself, let's now turn our attention to stewardship. Quality of management. A truly wonderful business, one capable of navigating these complex transitions we've discussed. It requires exceptional leadership, doesn't it? We need to evaluate AbbVie's management, their track record on capital allocation, and the strength of the financial fortress they've built.
Right. And AbbVie is actually navigating a highly anticipated, well-planned leadership transition right now. That's always a critical juncture for any big company. Richard A. Gonzalez, who's been CEO since the spinoff from Abbott Labs back in 2013, he's set to retire from the CEO role on July 1st, 2025. He will, however, transition to executive chairman, so he'll still provide strategic oversight. His successor is Robert A. Michael. He's the current president and COO, and crucially, a seasoned 31-year veteran of the broader Abbott-AbbVie organization. This long-planned internal promotion, it signals a strong commitment to strategic continuity, suggests a deep bench of leadership talent.
And how would you characterize Richard Gonzalez's tenure? What was his philosophy, his impact?
Gonzalez's tenure, I think, has been defined by a clear, consistent, and profoundly owner-oriented philosophy. His stated mission was always about making a remarkable impact on patients' lives through innovative medicines, while simultaneously creating substantial shareholder value through disciplined financial execution. And you can judge his leadership by the results, can't you? Since becoming independent, AbbVie's market cap has grown by over $250 billion. The company delivered an astonishing total shareholder return, over 700%.
700%.
Yeah. And his crowning achievement, without a doubt, was that masterful, decade-long strategic planning for and navigation of the Humira LOE, the loss of exclusivity. That level of foresight, that successful execution turning what many predicted would be a fatal blow into a managed transition. Those are hallmarks of a management team intensely focused on long-term resilience, not just short-term results.
And the incoming CEO, Robert Michael, what does his background signal for the future direction?
Robert Michael isn't a new face at all. He's been a key architect of the company's recent strategy, deeply involved in global commercial ops, finance, and critically, those major acquisitions of Immunogen and Cerevel, which are crucial for future growth beyond immunology. Upon his appointment, he immediately reaffirmed the company's long-term revenue guidance, strategic priorities. signaling that the successful multi-pronged strategy developed under Gonzalez will continue without major deviation. That provides a strong sense of stability, a clear path forward for investors.
Right. And a management team's true priorities, their strategic insights, they're always revealed by where they choose to allocate capital, aren't they? What can we say about AbbVie's capital allocation track record?
AbbVie's management has consistently deployed the company's immense cash flows across three main pillars, and it seems both highly rational and deeply shareholder-friendly. First and foremost, priority. Relentlessly fund the internal innovation engine, reinvestment in organic growth through R&D. They've shown an unwavering willingness to invest heavily. Adjusted R&D was $7.8 billion in 2023, bumped up even further to $10.8 billion in 2024. That reflects a deep, ongoing commitment to fueling future growth from within. They understand continuous innovation is the lifeblood of their business.
And beyond internal innovation, they've also been quite active on the M&A front, haven't they? That Allergan deal was particularly significant, transformative even.
Yes. Strategic acquisitions have been a core, deliberate tool for them, not haphazard, not opportunistic. It's a central part of their strategy to judiciously enter new therapeutic areas, acquire new technologies, bolster their late-stage pipeline, all aimed at building a more diversified, more durable enterprise. The most powerful example is certainly that transformative $63 billion acquisition of Allergan in 2020.
$63 billion.
Yeah. That deal brought in leading aesthetics and neuroscience franchises, significantly diversified AbbVie away from that prior heavy reliance on Humira. More recently, they've strategically acquired Immunology for $10.1 billion, specifically to strengthen their oncology franchise with novel antibody-drug conjugates, and Cerevel Therapeutics for $8.7 billion to bolster their neuroscience pipeline. These aren't random purchases. They're deliberate, well-researched moves to secure the next generation of growth platforms.
And finally, a point that consistently draws investor attention, their commitment to direct shareholder returns. They're known for that robust dividend, aren't they? A dividend aristocrat.
Absolutely. AbbVie has shown an unwavering commitment to returning capital to shareholders, primarily through a robust, consistently growing dividend. Since becoming independent in 2013, they've increased their quarterly dividend by more than 285%. Yeah, it's impressive. And that track record earned them that coveted place in the S&P Dividend Aristocrats Index, which requires 25 consecutive years of dividend increases, counting its history as part of Abbott Labs. Share repurchases. They've been used more opportunistically, often when management thinks the stock is undervalued, to further return capital. The rationality of this whole capital allocation framework is incredibly clear, I think. They astutely saw the Humira patent cliff threat years ago, used the enormous cash flows from Humira to simultaneously fund internal development of successors and diversify with Allergan. Now they're systematically using the immense cash from this broader portfolio to acquire new growth platforms, all while maintaining a strong commitment to growing that dividend, ensuring cash gets back to shareholders when it can't be reinvested at high enough rates internally or via M&A. It's a highly disciplined approach.
Okay, let's turn now to the financial fortress itself. How strong, fundamentally, is AbbVie's financial foundation? Can it weather storms?
AbbVie's business model, selling patent-protected, high-demand specialty drugs, it translates into exceptionally high and remarkably consistent levels of profitability. That consistency is really a hallmark of their underlying business quality, their adjusted gross margin ratio, consistently in the low to mid 80% range. We mentioned how rare that is. Even after significant R&D SG&A expenses, their adjusted operating margin has been remarkably stable, typically landing between 35% and 45%. What's truly impressive is that this high profitability proved resilient. It absorbed the initial expected hit from the Humira LOE in 2023 and 2024, that resilience. It's a testament to the fundamental strength of their diversified growth platform and that rapid ramp-up of Skyrizi and Rinvoq.
And looking at some key financial quality ratios beyond just the margins, what truly stands out about AbbVie's financial characteristics? Is there something hidden?
Well, historically, AbbVie was an exceptionally high return on invested capital, ROIC, business, a true measure of how efficiently a company generates profits from the capital it deploys. Now, that metric did see a notable but expected decline after the massive debt-funded Allergan acquisition. That significantly increased the denominator, the I, in ROIC. However, even post-Allergan integration, while it moderated maybe around 10% in recent years and ROIC consistently at or above 10% for a company of this scale, that's still indicative of a high-quality business creating substantial economic value above its cost of capital.
But this next point, this is arguably AbbVie's most impressive financial characteristic, isn't it? and something many investors might easily miss just looking at earnings. It's free cash flow conversion. It really is a cash-generating machine.
Absolutely. This is a critical insight, often overlooked by those focusing only on reported earnings, on GAAP net income. See, due to the accounting treatment of large acquisitions like Allergan, AbbVie carries a substantial amount of intangible assets on its balance sheet, goodwill, things like that. This results in significant non-cash amortization charges that get deducted to arrive at GAAP net income. Consequently, its reported GAAP earnings significantly understate its true underlying cash-generating power.
So the cash coming in is much higher than the reported profit.
Much higher. For example, over one recent 12-month period, the company generated a staggering $15 billion in free cash flow against just $4.16 billion in GAAP net profit.
$15 billion versus $4 billion.
Exactly. Nearly 4 times more cash generated than reported profit. This exceptionally high free cash flow conversion rate signifies extremely high-quality earnings, and it provides that massive recurring pool of cash that fuels the entire capital allocation strategy, R&D, M&A, the dividend. It's all fueled by that enormous free cash flow. It's the engine behind everything.
So even with the Allergan acquisition, the considerable debt that came with it, is the balance sheet truly strong enough? Can it withstand unexpected shocks? That debt level still worries some people.
The debt load from Allergan is indeed the primary financial risk, no question. It increased substantially to fund that monumental deal. However, management has approached this leverage prudently, systematically. As of late 2022, the net debt to EBITDA ratio stood at a moderate 2.00x.
2 times, okay.
Right. Now, for a business with highly predictable, non-cyclical revenues, people need these drugs regardless of the economy. And that immense free cash flow generation we just discussed, $18 billion to $22 billion annually, that level of debt is entirely manageable. The company possesses the formidable financial capacity to systematically reduce this debt over the coming years. And doing so will directly accrete value to equity shareholders by reducing financial risk and improving financial flexibility. It's a deliberate deleveraging strategy that's well underway.
Okay, now that we have a firm grasp on the business, the moat, the financials, let's turn to the investment proposition itself. Valuation, risks, potential catalysts. Historically, AbbVie has often traded at a valuation discount compared to the S&P 500, compared to some peers, often priced as value or GRP growth at a reasonable price, not commanding those premium multiples.
Yeah, and the market's reasoning for that persistent discount was, for a long time, painfully clear, that looming Humira patent cliff. For the better part of a decade leading up to 2023, the narrative was dominated by that question. How can AbbVie possibly replace $20 billion in annual revenue? This massive uncertainty acted as a powerful anchor on the stock's valuation. Investors priced in a high probability of a significant prolonged decline in earnings and cash flow. Now that the company has impressively demonstrated a clear, successful path through that, the narrative has shifted somewhat. The market's current focus seems to have moved to the high debt load from Allergan and other deals. While AbbVie has shown it's manageable, that debt still tempers investor enthusiasm, arguably caps the stock's valuation multiple, preventing it from trading at a higher premium, maybe.
This raises a really important question then. How do you find a margin of safety in a business like this? Because for AbbVie, it's certainly not about buying it for less than its tangible asset value, is it? The value isn't in buildings or equipment primarily.
Exactly right. The intrinsic value here lies not in physical assets, relatively minor compared to market cap, but almost entirely in the discounted value of future cash flows generated by those powerful intangible assets. Patents, intellectual property. Therefore, a meaningful margin of safety for an AbbVie investment would arise from a significant disconnect between the market price and the intrinsic value of that durable long-term cash flow stream. Several scenarios could create such an opportunity. One, you mentioned it earlier, a broad market-wide panic. A severe recession, a market crash, often leads to indiscriminate selling. High-quality businesses with resilient earnings get sold off alongside riskier stuff. In that scenario, you could potentially acquire AbbVie's highly resilient, non-cyclical cash flows at an unusually high initial yield. For example, if the dividend yield spiked above, say, 4.5% or 5.0%, that would typically signal a level of market fear that could provide a substantial margin of safety for long-term investors.
And what about something specific to AbbVie itself, not just a market meltdown?
Right. Another scenario would be a company-specific but temporary setback. The market often overreacts to negative news, right? Fails to distinguish short-term noise from permanent impairment. So a margin of safety could be created by a sharp, fear-driven sell-off in response to an event that does not permanently impair the company's long-term earnings power. Examples: maybe a negative headline about a mid-stage pipeline drug that isn't really central to the core thesis. A phase 2 trial misses its endpoint, but it wasn't the main growth driver anyway.
Or a quarterly earnings miss.
Exactly. An earnings miss due to timing of expenses, inventory adjustments, something that doesn't reflect underlying business weakness, even renewed political rhetoric about drug pricing that ultimately proves more bark than bite could create a temporary dip in opportunity. The key for the investor is exercising critical judgment. Is this temporary, or is this permanent damage to the moat or earnings power? That's the hard part.
Warren Buffett famously said, "Price is what you pay, value is what you get." This seems like the ultimate determinant for investment returns here, and AbbVie is a great case study.
Indeed. Business quality is only one part of the equation. The price you pay for that quality is just as crucial, maybe more so sometimes. Think about it. An investor correctly identified AbbVie's durable moat, the brilliant transition strategy, but paid a peak valuation multiple in early 2022. That was before the full Humira LOE impact was priced in, before Skyrizi's Rinvoq's ramp-up was undeniable. That investor likely saw stagnant or even negative returns for a while, despite the underlying business strength.
Right.
Conversely, an investor who recognized that same underlying strength, but bought the stock during peak pessimism about the patent cliff, they would have been handsomely rewarded as the market eventually appreciated the explosive growth of Skyrizi and Rinvoq. For a company like AbbVie, generating relatively predictable, stable cash flows, the entry price you pay is arguably the single greatest variable controlling your ultimate rate of return. Even a wonderful company becomes a poor investment if the entry price is too high. And a good company bought cheap can deliver exceptional returns. Price matters immensely.
Looking ahead then, what's the clear primary growth engine for AbbVie over, say, the next 5 to 7 years? What's driving the train?
The single most important, identifiable, and non-speculative driver for AbbVie's earnings growth is the continued global commercial success of that next-generation immunology platform, Skyrizi and Rinvoq. This isn't hopeful speculation, it's the core of their stated strategy, and it's being validated quarter after quarter in the financial results. Management explicitly guided, we mentioned it, expecting combined revenues of those two drugs to hit more than $31 billion by 2027. That doesn't just replace Humira's peak revenue, it substantially exceeds it, firmly reestablishing, maybe even expanding, AbbVie's dominance in the multi-billion-dollar global immunology market. Continued expansion into new indications, more types of Crohn's, ulcerative colitis, atopic dermatitis, plus aggressive market share capture from competitors. That's the primary engine for growth for the rest of this decade.
Okay, if we connect this to the bigger picture, what are the most significant risks? The things that could cause permanent impairment, fundamentally damage the business model they built so carefully.
The single greatest long-term threat to AbbVie, and frankly to the entire biopharma industry, is the risk of fundamental government-imposed changes to the U.S. drug pricing model. The Inflation Reduction Act already introduced government price negotiation for certain drugs in Medicare. That's just the start, potentially. Political pressure to control healthcare costs is immense, persistent, increasingly bipartisan. More aggressive future legislation expanding price controls to more drugs, significantly shortening exclusivity periods, undermining the patent model that could permanently reduce profitability and the ROI for the entire industry. This is an existential risk. It could impair the long-term earnings power of all of AbbVie's key products, regardless of their clinical efficacy. It's the big one they constantly lobby against.
What about risks closer to home, related to their own pipeline development or that aggressive M&A strategy?
Right. Long-term growth beyond the current Skyrizi Rinvoq cycle depends heavily on the success of the current pipeline and future acquisitions. A catastrophic failure of a key late-stage asset, particularly from the recently acquired oncology, immunogen, or neuroscience, cerebral platforms, could leave a significant unfillable revenue gap in the 2030s, basically creating a new patent cliff scenario without the corresponding replacement ready to go. Clinical trials are inherently unpredictable. Even promising candidates can fail late stage due to efficacy or safety issues. Similarly, a major misstep in M&A, grossly overpaying for an asset, acquiring a company with unforeseen legal or clinical issues, failing to successfully integrate a complex acquisition. That could result in massive write-downs, permanent destruction of shareholder capital. We've seen deals like that go wrong elsewhere. And finally, there's the devastating but ever-present risk of unforeseen safety issues with a blockbuster drug.
Right, something discovered years later.
Exactly. Discovering a serious, previously unknown long-term side effect with a major product like Skyrizi or Rinvoq, even after it's been on the market for years. That could lead to market withdrawal or severe restrictions by regulators. That would be a truly devastating blow, immediately erasing a significant chunk of earnings power, severely damaging reputation, destroying the core growth thesis. It's low probability, hopefully, but extremely high impact if it happens.
Okay, on the flip side, are there potential catalysts that could unlock or accelerate value creation, things that could positively surprise the market in the near to medium term?
Absolutely. One key catalyst would be successful pipeline readouts in those new therapeutic areas. Positive late-stage clinical trial data from assets acquired from ImmunoGen, especially those next-gen antibody-drug conjugates in oncology and Cerevel in neuroscience. That would be a powerful catalyst. Success there, showing these acquired assets are indeed potential blockbusters, would validate the M&A strategy, de-risk future growth, and prove to the market AbbVie can effectively build successful growth platforms beyond its traditional immunology stronghold. That diversification story would be very well received. Another significant catalyst, accelerated deleveraging and capital return. If the company's immense free cash flow generation continues to exceed market expectations, maybe even management's guidance, they could pay down that acquisition debt much faster than the market currently anticipates, reaching their target leverage ratios ahead of schedule. That significantly increases financial flexibility. It could unlock a new phase of capital return, potentially a big increase in share repurchases, which would be highly accretive to earnings per share. That improvement in the balance sheet's risk profile could lead to a significant re-rating of the stock's valuation multiple upwards.
Okay, let's unpack this now with some second-level thinking. Let's push beyond the obvious, beyond the general consensus. What is the prevailing market consensus, the first-level thinking on AbbVie right now? How does the average analyst see it?
The current prevailing market narrative seems to be one of maybe cautious optimism, almost a sigh of relief, perhaps. The consensus view is broadly something like, okay, AbbVie did an impressive job managing the Humira cliff. Skyrizi and Rinvoq growth is strong, yes, but they had to take on a mountain of debt for Allergan and others to diversify. That debt still hangs over the company. So it's now a solid dividend-paying pharma stalwart, but the high leverage, the persistent regulatory risks from Washington, they'll likely cap the upside. It's a good, stable company, but maybe not a great investment with significant appreciation potential at the current price. It acknowledges past success, but implies a somewhat constrained future.
Okay, here's where it gets really interesting as we peel back another layer. How does second-level thinking challenge that comfortable consensus? What might the market be missing or underappreciating?
A true second-level analysis challenges that view on several critical fronts, I believe. While the market correctly identifies the debt, it fundamentally fails to appreciate the velocity, the quality, and the sheer durability of the free cash flow AbbVie generates, and how rapidly that cash flow will be used to service and ultimately eliminate that debt. Remember those GAAP earnings, misleadingly low due to significant non-cash amortization charges. This causes many traditional PE investors to severely misperceive the company's true underlying earnings power, its cash-generating capabilities. The debt, therefore, is best understood as temporary, not permanent. It's a feature of the balance sheet that's being actively managed down. As this debt gets rapidly paid down over the next several years, a tremendous amount of value will automatically accrue to equity holders through balance sheet de-risking, increasing financial flexibility. Furthermore, the market is largely still mentally framing Skyrizi and Rinvoq as simple Humira replacements.
Just filling the gap.
Exactly, and this is, in our view, an error of analogy, an underappreciation. Due to their superior clinical profiles, more targeted mechanisms, compelling efficacy data, often surpassing Humira in trials, these drugs have the potential to achieve significantly higher peak sales and command a more dominant market share for an even longer period than Humira ever did. The market seems to be pricing AbbVie as a company that merely survived a crisis, limped across the finish line. Our second-level view suggests it may have emerged from that existential threat with a more powerful, more diversified, and more durable core earnings stream than it had before. The current valuation doesn't appear to fully reflect the long-term economic power and growth potential of this new, upgraded immunology fortress, nor the hidden value in its prodigious free cash flow.
So let's distill this into a concise summary, like a one-pager. What's the powerful bull case for AbbVie? The key reasons you might want to own this company?
Okay, the bull case rests on 4 robust pillars, I think. First, a truly durable, defensible economic moat in a fundamentally non-cyclical industry. Patent-protected, high-margin drugs addressing critical non-discretionary needs. Proven institutional capability for innovation, commercialization, legal defense. Repeatable process, proven post-Humira. Second, Exceptional and, crucially, underappreciated cash generation. Immense, high-quality free cash flow significantly exceeds reported GAAP earnings. This torrent of cash fuels R&D, M&A, debt reduction, and that growing dividend, all within a disciplined framework. Third, proven and rational capital allocation, superb long-term track record, masterful navigation of the patent cliff via R&D and transformative M&A. Consistent shareholder returns. They put capital where it earns the highest returns. And fourth, a clear, visible growth pathway. Skyrizi or Rinvoq platform provides multi-year, high single-digit revenue growth runway through end of decade, supplemented by upside from oncology neuroscience acquisitions, providing diversification and future streams.
Okay. On the flip side, what's the bear case? The most compelling counterarguments. Reasons an investor might stay away.
The bear case also rests on 4 key points. First, the leveraged balance sheet. Substantial debt from M&A increases financial risk, could limit flexibility if they face an unexpected stumble, clinical setback, or severe downturn. Second, that existential regulatory risk. Fundamental vulnerability to systemic U.S. drug pricing reform. Could permanently impair profitability, reduce ROI across the board, an industry-wide sword of Damocles. Third, pipeline and M&A integration risk. Future growth beyond Skyrizi or Rinvoq relies on unpredictable pipeline success and successful integration of complex acquisitions. Major failure could create revenue gaps, destroy capital. And fourth, therapeutic area concentration. Despite diversification, still heavily reliant on immunology. Creates exposure to new competitive entrants, shifts in standard of care that could disrupt dominance.
What stands out to you here is the most compelling argument for why an investment in AbbVie today could become a major long-term mistake. Let's really invert the bull case, challenge our own assumptions.
The most compelling argument for a long-term mistake. It's a narrative of peak and decline. It argues we're mistaking a successful one-time escape from the Humira cliff for a repeatable ongoing process in a changed environment. This counter-thesis says, yes, the Humira navigation was brilliant, extraordinary, but it was done in a different era. The industry, competitors, crucially, regulators, they're now on high alert. That patent thicket strategy won't be allowed to be as effective, won't buy as much time for Skyrizi or Rinvoq, leading to shorter, less profitable exclusivity than the market expects. Simultaneously, the U.S. government, increasingly burdened by healthcare costs, will inevitably enact stricter, more widespread price controls, fundamentally lowering the terminal value, the profitability of all future assets. In this new lower margin world, AbbVie's massive debt load taken on at the peak of the old higher pricing paradigm becomes an inescapable albatross. Management gets forced to divert most of that prodigious free cash flow to just servicing debt, starving vital R&D, preventing needed M&A for the next patent cliffs in the 2030s. The result isn't a sudden collapse, but a slow, grinding decline, transforming from high-margin innovator to stagnant, utility-like entity, leading to severe, permanent multiple compression, inflicting substantial, irreversible capital loss on investors buying today. It's a compelling, if pessimistic, inversion.
So what does this all mean for you, the listener, the investor? AbbVie is truly a fascinating case study, navigating immense industry challenges, highlighting the profound importance of understanding underlying institutional capabilities, strategic foresight, things that often extend far beyond single product cycles.
Yeah, if we connect this to the bigger picture, it really raises an important question for all of us, doesn't it? In a world constantly focused on short-term news, quarterly reports, immediate reactions, are we truly capable of appreciating the power of a long-term, repeatable strategic capability in pharmaceutical innovation? Are you looking for the next big, flashy thing that might burn bright and then just fade away? Or are you looking for that enduring strength, that deep organizational fortitude that powers innovation, no matter the specific drug, quarter after quarter, decade after decade?
Something profound to ponder as you continue your own deep dives into the world of investing. Until next time, keep digging for those insights.